Good afternoon from Shreveport, Louisiana for the latest edition of the Jack and Bill Show. It's April the 14th. It's a beautiful day outside. The sun is shining, blue skies, and income taxes are due on the 18th. So we're scrambling to make sure we have everybody's money and checks ready. Unfortunately, we have some money going out the door next week, but that's okay. That's because there was a whole lot coming in this past year. And it's been a while since I sat in this chair. Go ahead, William.
You know what they say about paying taxes?
What's that?
It's better that you owe taxes than not owe taxes.
Absolutely. I agree with that. So who would have thought, William, I pick up today's Wall Street Journal this morning, and all of a sudden the S&P 500 is up 8.5% this year. I think the Qs are up something like 20% after being down 30-something% last year. The Dodge and Cox Income Fund is up 3.5% this year after, I think, 2 negative years in a row. And last year we were telling everybody that 60-40 is dead. So
no,
I think
not dead.
Last year it was dead.
Yeah, I mean, we would never say it's dead. I mean, that's what financial media likes to say.
Well,
I mean, we said there's a better way. And
yeah, so last year
there was a better way.
2022, the 60 part was dead. Mm-hmm. Stocks went down 20% plus. The 40% part was especially dead because we started out the year with yields around 1%, CDs under 1%. So the 40 part fixed income, you could get 1 or 2%. But if you went for all that last year in intermediate or long dated bonds, you lost 15%. So
Correct.
What that means is 2023, let me back up. So for 2022 and before, we kind of went to like 60, 2020, beat the bushes in lower tier investment grade, baby bonds and things like that, finding 5 to 6 to 7% stuff that's short term, still investment grade. And then instead of 40, we did 20% of that and 20% in alternatives, which served us very well last year. This year, we've got some disruptions occurring in the credit markets a little bit. I actually think that that's going to have legs because we are likely heading into or close to a recession later this year. But given the sell-off in stocks and bonds last year, it shouldn't be terribly surprising to us that the S&P 500 is up 8.5. It is surprising to me that the NASDAQ market is up so much because the Federal Reserve has continued to tighten, and the odds are they're going to tighten again at the next meeting and then perhaps pause. All that's data dependent. CPI.
But it's like we always say. I mean, markets are discounting mechanisms, so they are discounting the future. So the markets are looking through the current news cycle and looking to an expectation that rates and inflation are coming down. That's what the market is saying.
Right. And so, well, I mean, that's the thing. If you look at this historically, though, forecasters, not only do they miss the magnitude of interest rate forecasts, semi-annually, they 68% of the time I've read they get the direction wrong. So I think nobody thought that we were going to see CPI inflation go up to over 9%. So it's been really kind of sticky coming down. It does appear to still be coming down, but given the shakeup that we had last year, going back to our seasonal theme, or you could even still call this a forever theme, even though last year may have been somewhat of an aberration. 60-40 is back. We're doing the 60 part a little bit more unconventional than most. And but the 40% part, we're a little bit unconventional with that too. But now you have short-term even CD yields. You can get 5%. You could, at the height of this Silicon Valley Bank failure, you could buy CD yields approaching 5.5%. So that's calmed down a little bit.
Yes, the CD market is slow or slower to react than the Treasury market, and we saw T-bill yields spike first and stay elevated higher than CD yields. So the opportunity up until about a month ago was in T-bills, and now, as I said, T-bills respond more quickly. We've seen T-bill yields start to move down, and CD yields are now more attractive.
Yes, relative to when you compare them to each other. Yeah, and it's probably going to stay that way for a season until America has more confidence in our banking system. You agree with that, William?
I mean, that certainly could be a factor. But we could also see, if some banks need liquidity right now, more liquidity than they've had. In hindsight, we have a better understanding of what happened with Silicon Valley Bank and the two other banks that had to be rescued. And, we really, the narrative is that we had all the stimulus money from the federal government in response to the pandemic. All that money was flowing through the economy. Consumers were flush with cash. They built up their savings with that money in the banks. And because interest rates were at the zero bound, banks didn't have to pay anything on those deposits. So banks did what they would expectedly do. They took in the deposits. They were paying little to nothing on those deposits, and they invested them into longer dated bonds. The difference between now and the 2008 credit crisis was that because of more stringent banking regulations, banks had to be more prudent with the types of bonds they were buying. So they were buying high quality bonds, but there was a mismatch. So they had short-term liabilities in the form of deposits, and their assets were longer dated bonds, treasuries, government agencies and such, high quality. But with the bond market in correcting last year, these bonds in their portfolio dropped in value. And when depositors started pulling money out of the banks because the banks weren't paying anything and they could earn many times or many multiples higher in money market funds, they're pulling money out of the banks to invest in money market funds. Banks are having to sell longer dated bonds to cover the redemptions of their depositors. In hindsight, we have a good understanding of what happened. So now we're in a situation where some banks do need to replenish, and they may be issuing CDs, to get more funds in the bank.
It's interesting that in hindsight, this is so obvious.
Oh, everything is obvious in hindsight.
That if you look at Silicon Valley National Bank, all of a sudden they very subtly wanted to do a capital raise, and it leaked out that they were struggling, and so $42 billion went out the door in about 10 minutes, and that left them upside down because I think they were down on average about 20% in those securities. So that's huge.
Yep.
And but it also, in hindsight, our Federal Reserve and U.S. Treasury should have seen this coming, because you could argue that our Federal Reserve actually created this problem because they were very slow to hike rates coming out of the pandemic. They let inflation go way too far too fast. Then they responded way too slow by hiking rates, and having already encouraged all these banks to own long dated treasuries in their held to maturity sub accounts.
Yeah. The Fed is complicit, but if you really want to go to who is ultimately responsible, I would say it's the federal government. All the stimulus money.
Absolutely.
And
all
the stimulus money spurred the inflation.
So what did you want to visit with our viewers about this afternoon, William?
I'll just, you brought up the 60-40. And I just, what I said earlier, I wasn't correcting what you said. I was really just adding some clarification because, you never want to say that an asset class is dead. You never want to say that an investment strategy is dead. I mean, those are the kinds of headlines that you see in financial media. And it's really just to get, pique your interest and get you to buy their publication. We've seen this over the years with claims that stocks are dead, bonds are dead, whatever. But it's really a question of timing. We know historically that over a long period of time, a portfolio strategy like 60% in stocks and 40% in bonds is a good strategy for the most part. But there are times when
historically that's given you 8% with way less risk than having your money 100% in stocks.
Absolutely.
Yeah.
It's been terrific. But there are periods of time when it doesn't work for you and it can hurt you. And we saw that last year because stocks were correcting, but at the same time, bonds were correcting too. And in our lifetimes, that's kind of rare to see both stocks and bonds correcting because we've gotten accustomed to when stocks correct that there's a flight to quality into bonds, and bonds provide the ballast, to hold up the portfolio.
Well, that brings up an interesting point, to me, because we're talking about seasons, and there needs to be a distinction between a season or seasonality, a cycle, a trend, and that which is secular. Okay.
Yeah, that's great.
So a season, you can think of a season just like the seasons of the year, spring, fall, winter, and summer. And then a cycle like the business cycle, which is typically, 5 or 6 years in length. I think with
it's also called the economic cycle.
With the advent of central banks gone wild, there's some business like Australia went 24 years without having a recession, for example. So, but typically, the business cycle is 5 or 6 years, and then we have that which is secular, which is a very long time.
Yes.
But this season that we're entering in right now, I think, and what we saw last year could actually be, we've gone through a correction back to some relief from all the troubles of last year. But I'm of the belief that there's a significant probability that long-term interest rates could be in a secular trend of going back up. Now, if we have recession, we're coming down right now because the market's discounting the possibility or higher probabilities of a recession. And historically, when you go into recession, inflation is not really a problem. You can even have deep inflation because people aren't spending money. There's not a lot of money chasing, too few goods, which is actually what we've experienced up until now. And we did see this in 1966, Bill. This is the first time the Dow Jones hit 1,000.
I didn't see it.
And I was 5 years old. And I was not trading stocks then, though. But I was walking around looking up at the sky with ADD, picking my nose. And
some things never change.
But the point is, the Dow first broke 1,000 in 1966, and guess where it was in 1982?
The same.
It was the same.
Yeah.
And that was a period where where we got way behind inflation, and cigar smoking Paul Volcker entered the scene and raised rates dramatically, all the way up to I think the Fed funds rate got to around 16.5%, somewhere around like March of 1980. And then we had this secular period. So that was the peak. Interest rates, long-term interest rates, really, the yields really follow secular patterns, with seasonal stuff. I mean, so that was 1980. Bill, that was a peak in interest rates that was 40 years ago.
Right.
Are we going to go back to that? Some people think that that's a distinct possibility given all the central bank monetary, shenanigans that we've seen. But we did have a scare with this last year. It looks like, at least temporary, there's some things under control with that. But I think we're going to see interest rates higher for longer. And I think one of the things that kind of concerns me a little bit with this is, last Friday's jobs number, the unemployment rate fell back down to 3.5%. And that presents problems potentially, with inflation. But I think one of the things to take away from all this is that we want to be diversified. Mm-hmm. We've got some things going on with the possibility of a forthcoming recession. We've got commercial real estate doing terrible. Today's Wall Street Journal, I read a headline that San Francisco has 30% of their office space is vacant. There's going to be, if you think about this,
that's not as bad as Shreveport.
Now think about, that's true. If you think about all these tenants that have long-term leases, and these things are coming due, and the interest rates, are going higher as well. So this is going to present some problems in the days ahead.
Well, they say all real estate is local, and I mentioned Shreveport tongue in cheek. I mean, the Shreveport downtown market, has its own attributes driving that vacancy percentage, and similarly in San Francisco. I mean, we know that there are vibrant markets, especially in the South and Southeast, that don't have vacancy rates like that.
Malibu, the priciest trailer park in America.
There you go.
They have these things typically generate $2,500 a month rents, but you've had people like I read this just this morning, William. I think this is kind of interesting. You've had Matthew McConaughey, Stevie Nicks, Sarah Paulson, Minnie Driver. They've all owned these trailers in these.
Yeah, but Jack, those don't look anything like the double wides that I see around here.
No, they do. They've fixed them up.
They're nice trailers,
and they go for $2 to $5 million a piece. So that's the most extreme, up to $5 million.
Well, I want to get back on the topic of the 60-40, because you mentioned that this in the context of seasons, and you talked about cyclical seasons and secular seasons. I would say for most people, especially those who are younger, when you come up with an investment strategy and an asset allocation that's right for you, and the asset allocation is just simply what is the mix between stocks and bonds and alternatives if you want to introduce that third asset class. That's something you can stick with for a long time. And yes, there will be shorter seasons, cycles, when your performance will be less, but over time, you'll still be better off having stick to your strategy. And I think over the long run, people who have a strategic asset allocation strategy and stick to it will be just fine. We try to be more tactical in our approach. Yes, we have strategic allocations that we set for every client, but then tactically we'll make adjustments to account for market conditions. And that's what's often missing in the analysis, is people will set it and forget it with a strategic asset allocation model, but they're not taking into account current market conditions. So what if current market conditions say that stocks are grossly overvalued or bonds are grossly overvalued? Why not make a tactical adjustment to take those into account?
Well, and here's to your point. Here's the biggest, most obvious example for this is if you look at bonds versus stocks on a relative basis. Okay, and the easiest way to do this, Bill, I don't know if we've ever talked about this before, but everyone gets very focused on the PE ratio.
Right.
So if you have a stock that sells at a 20 PE, which is about where the market is right now, and historically that's kind of a high number, and that number can escalate as interest rates go down. Things are worth more.
Right.
Well, now we have things going the other way, and PEs are still around 20, which is high. So you take the PE. If you have a company, you have a $20 stock, and they earn $1 per share in earnings. That's 20 divided by 1 equals 20. So you pay $20 for every dollar per share that company XYZ earns. Now flip that around, instead of a PE, call it an EP. And the earnings yield on that is 5%. So now you compare the earnings yield to the 10-year Treasury yield. Okay. And this is where we got an enormous divergence in the last 15 months. And what do you do with that? You do exactly what we're doing with it. It makes, you look at the Vanguard Group. I think they're the largest mutual fund company group in America. They're certainly among the top 3. They have equity projections for large cap equities to return somewhere between 5 and 7% for the next 10 years. That's way below the historical average of 10. And now you have bonds that were yielding only 1 to 2% a year ago, and now they're yielding, as we've said earlier, on short-term fixed income, we can get 5 or 6 or even 7 on investment grade paper. So here's a place for a tactical consideration to take. You take a profit in some equities that have gone up, or NASDAQ stocks today that have run up 20%, and you put it into increase your tactical allocation from equities to fixed income, where short-term fixed income yields very close to what a lot of people are forecasting for equities, and can't be all that terrible of an idea if we think that a recession could be around the corner. So I thought I would just throw something out for a minute or two, and I went and stayed at a friend's house on the beach in Ponte Vedra, Jacksonville, Florida, and went to an investment conference that was put on by a newsletter writer called the Oxford Club. And I left there. I sat through a bunch of meetings over 3 or 4 days, and there's maybe 200 people in the room of, interestingly, most of the people in the room were probably do-it-yourselfers, but it was a highly affluent crowd there. And the average net worth, there were quite a few ultra-rich, people in the room. And it was interesting to hear, some of their best ideas. Actually, they recommended one of their favorite just single stock ideas, and it's too late for this today, but they recommended JP Morgan Chase, because a huge beneficiary of the banking crisis for these small and regional banks is don't worry about FDIC if you're in a bank that's so-called too big to fail. So a lot of money that came out of banks went to Bank of America and JP Morgan. JP Morgan Chase is up like 6% today, on surprisingly very strong earnings and outlook. And I feel stupid, not having done something with that. In hindsight, everything looks obvious, right? But some of the takeaways, they have a gentleman, Mark Lichtenfeld, that's he's an HBO and MMA announcer and very talented, gifted guy. Wrote a book entitled "Get Rich with Dividends," and it's interesting because we actually have exposure with some of the most promising names in there. But his favorite stocks are stocks that pay dividend yields of 4% or more, that have typically raised their dividend for 25 years in a row or more. Those are called aristocrats. But you take the ones
Dividend
aristocrats, 4% yields or more, and then you try to find some that have grown their dividends at 10% compounded for 10 years or more. And there's only roughly a handful of those. But if you have any interest in that, but some of the ones showing up in there are energy names right now, including some of our clients won't like this because we find that with the MLP structure, master limited partnerships, 80% of all MLPs are energy related. But we own one in most client accounts that yields almost 10% today and doubled their dividend. They raised their dividend 5 quarters in a row and doubled the dividend just in the last 5 quarters. This is a stock we bought as low as $2 coming out of the pandemic, and it's almost $13 today. And their fundamentals are rocking. And that's a midstream energy company that has almost 12,000 miles of pipes moving liquids and gas all across America, and even to the Gulf to be liquefied and put on transport ships to go to Europe and Japan. But I'm just saying, and one of the eagle ways of going back to the 60-40 is we like low value. We still continue to like low valuation, higher than average dividend yielding companies. We like short-term bonds versus intermediate-term bonds, where we're getting 5 to 7% yields, much higher than a year ago. And we still like managed futures, trend following, algorithm run funds in the commodity space. And a couple of the takeaways, though, I didn't agree with all the stuff that I saw there, but they had a gentleman who ran the U.S. Mint, who was a presidential appointee and was appointed under 3 presidents. And I got to visit with him for 10 minutes, and he was like a real hero to me. I loved his presentation, but they recommended 5 to 10% in precious metals. Now, a lot of people, for us, that sounds like from just traditional stuff that we read, that seems like a high number. But gold is down 1% today, around 2025. I think it was over 2050 yesterday. And the high-end gold happened right after the pandemic at around 2069. But one of the themes at the investment conference is that gold and silver and precious metals and even crypto have really kind of proliferated with the developed world debt to GDP expanding out of control. And I'm actually of the view that precious metals are going to continue to go higher, and I think they deserve a weighting in client portfolios, and we're already doing that in a significant fashion. But that just brings up the whole point again of there's many different ways to do the 60-40, and but we do think heading into a recession, it's a time to be very, diversified. So I'm kind of rambling, Bill. What do you have to add to that?
I agree. You're rambling.
But I came away with some names that had 50% dividend growth. That's 50% per year, for 5 years. Companies looked at a couple of REITs, actually a REIT, 2 small cap REITs, one in the, I've actually begun to nibble at this, yields well over 5%, with very strong dividend growth and heavy insider buying. That's a good thing to look at. And but anyway, so 60-40 is back, and
it never left. It's just that we expect it will return to the expected performance. We certainly didn't have it last year. Bonds I think will really shine this year. So if you've got your strategic allocation, 60-40, 50-50, 70-30, whatever, look for bonds to really help you out going forward.
I'll throw one last thing in there to close, unless you want to add to it. But I talked to a gentleman on the phone this morning who called me and who came into an inheritance recently. Unfortunately, he had a family member pass away, and I told him, it is you shouldn't be waiting with a huge pile of cash sitting in a bank account earning 0.5% to 1%, and it is easy. If there is anybody out there watching or listening, and you've got money sitting in the bank, it is easy today to make 5 or 6%, at least for the next year or so, in our view, with just because of what's happened in the fixed income markets in the last year. And then this is a guy who's very risk averse, and I said, hey, we can have a weighting of 75% in fixed income and 25% in other stuff, special situations, alternatives, high dividend paying common stocks, things that we like, and we'd be targeting returns of 7% with very little volatility. So if anyone out there finds that themselves in any kind of predicament like this, or with large cash balances, give us a call. Come in and see us.
I think that's a wrap. Have a great weekend.